Good evening. Tonight we're going to talk about chapters 1 through 4 as a review for the first exam in your Accounting 101 class. This is a synchronous seminar for statewide Accounting 101 courses. I know that a few people online may have completed their exam before, so we will get at the end of this to Chapter 5, so we can do a short introduction on Chapter 5 for those folks. But keep in mind that if you're sitting on here and you've already completed your exam, it is very useful to go back and review the first 4 chapters of the textbook, because they are the complete accounting cycle, and sometimes it's still a little muddy in your heads at this point in time. And hopefully, as you hear it talked about more and more, it begins to make more sense as we keep continuing to review over and over and over again. If you have any questions during this seminar, go ahead and raise your hand. I'll try to watch and answer questions as they come up. I know you can't see each other's questions. I will periodically ask questions throughout this. My expectation is that you would respond by typing your answer in the box. At the end of the session, I will open up the mics and we can have some verbal questions if that works for you better than typing questions. Typically, I get very few questions that way, but as long as we don't have so many attendees that can't be managed, we can do that. We may have to raise our hand still and let me call on you in order to get good questions without lots of people talking over the top of each other. Okay, let's start talking about Exam 1, the type of things that you'll see on Exam 1, and some things that you can do to improve your score on Exam 1. Exam 1 is going to consist of 4 multiple choice questions. You will have 90 minutes to answer these multiple choice questions. They're worth 2 points each. In order to prepare for the multiple choice questions, you might do some of the quick check questions at the end of the chapter in your book and check your answers with those answers that are provided at the very end of your chapters in each chapter. You can also review the quick checks and some quiz questions in the study plan, and I'm not, I'll go ahead and click through that here so that you can see how the study plan works as well. If I can get to it. To get to the chapter study plan, you have the link from your Blackboard class. If I were going to look at Chapter 3, for example, for my study plan, I can click here and I can click in my actual questions, and then I can pick, this is an example of what I was talking about. If I wanted to click on quiz 355, I could click and it's going to pop up a question for me to answer. Unadjusted net income equals 8,000. Calculate what the net income will be after the following adjustments. So if I had a net income of 8,000 and I had a salaries payable to employees of 560, my income is going to go down by $560 because that adjusting entry would be salaries expense, and an expense reduces my net income. If I had interest due on a note payable at the bank, then if I have a note payable, I'm going to have an interest expense as well. So that, again, $150 more is going to be deducted from my net income. If I have an unearned revenue that has now been earned of $900, then that would increase my revenue because that adjusting entry would be a reduction to my unearned revenue account and an increase to my revenue account, and a revenue increases net income. And if I've used up supplies of $200, that would decrease my revenue by $200 or my net income by $200 because that entry would be supplies expense and as a debit and supplies as a credit. So that would be an example. I could go through and answer this, and I've got the Help Me Solves It and the video links, and these are the same videos that you would link to or get to that I'm going to show you here in the multimedia library. If I do go to the multimedia library, I have several videos to choose from. I can get to those by clicking on all chapters in the video, and there's several videos you may want to look at to review for the test. Specifically, the accounting equation is a good one. Looking at how all of these accounting principles and concepts, anything, the real world's not so much, but any of these others, the more you have time to flip through and watch, the better. They're 2 to 3 minutes, most of them. Rules of debit and credit is a good one. The journalizing transactions, preparing this trial balance, very good. And as you can see, there's several for adjusting entries in Chapter 3 and closing entries. And then we could look at how we perform a bank reconciliation. Those will all help you for the multiple choice questions, and in fact they will help you for the problems part of the exam, which is worth 20 points for questions, and you'll have 65 minutes to complete that. You will be doing the type of problems where you have to journalize, do posting of those transactions. You will construct financial statements, which would be the income statement, statement of retained earnings, and balance sheet. And you will have to perform a bank reconciliation as well. I know most students can get really stressed out when they not have a timer on a test, but if you prepare before you start the test, you'll find that you have plenty of time to complete it. Will you have time to look up 40 multiple choice questions in your book and to try to determine the answer? No, you won't. That's why you study ahead of time and prepare ahead of time for an open book test, and then you will have time to look up a few of the questions that you're not sure about, but not all of them. That's the purpose behind putting a timer on a multiple choice test, so that you have to prepare and try to learn the material instead of just reference everything. I want to work through a little bit. I just keep popping up something I don't want to pop up. I want to work through this worksheet that we've looked at a few times, or my class has looked at a few times. And it is going to actually let us review the rules of accounting, and we're going to work through some transactions and look at some memory hooks. We'll do transactions as far as the transactions to open a business. We will post those transactions, do a trial balance. Then we will complete the adjusting entries that would be required, post those, do another trial balance, create our financial statements, and do the closing entries. Now, of course, in order to do all that in an hour and to do it quickly here, we will most certainly be doing a simple company, but that's what we're going to look at as our review. First of all, let's talk about the rules of accounting. The basic accounting equation is assets equals liabilities plus our stockholders' equity. When we have the expanded accounting equation, like I'm showing here on my screen for you, and I hope everyone can see, is splitting out my stockholders' equity into different elements or different types of accounts that would fall under the stockholders' equity umbrella. So we would look at common stock, retained earnings, dividends, revenues, and expenses. You're going to need to know the definitions of what each type of these accounts are, with assets being the resources of the company that they have to use to make money with. Liabilities would include anything the company owes to others. Common stock is the equity portion of ownership in the business. Retained earnings is the cumulative earnings of the business over its life, less any dividends that it has paid out. Dividends are what we pay out to our shareholders. Revenue is the monies that we earn in doing whatever the business is doing, whether it's the selling goods or providing services. And expenses are the cost of those assets or resources that are used up in the process of earning that revenue. often we get all caught up with the words debit and credit. We think that, many of us think that credit is good, debit is bad. That's not really the case. As you look at what debit means in accounting, what it means is left or left side of the transaction. If you look here, I have debit on the left side, and I have got debit in blue. It's on the left side of each one of my little T accounts, more terminology. I have T accounts drawn. On the T accounts, the left side is the debit, on the right side is the credit on every single classification of account. Okay, so debit's always on the left, credit's always on the right. Okay, a T account represents the general ledger. The general ledger is where we post all of our journal entries to. It's our way of keeping track of exactly what the balance is in cash, or exactly what the balance is in accounts receivable or supplies. You all sort of do this thing. If you have a check register for your checking account, you all keep track of your increases and decreases in that account. It's the same thing, only we're keeping track of our increases and decreases in each account on the company's chart of accounts, the whole list of accounts that the company uses. As we look then more further at this, I have a big green plus sign on the increase side or the normal balance side of each account. Assets increase on the debit side, therefore they decrease on the credit side. Liabilities and stockholders' equity accounts increase on the credit side. That has to be the case to keep my assets in balance with my liabilities and stockholders' equity in double entry accounting. When I look at my different classifications then of my stockholders' equity, you begin to notice, well, my common stock increases on the credit side, my retained earnings on the credit side, and my revenue on the credit side. And that is the way it works because expenses reduce revenue and dividends reduce our retained earnings. And so the two accounts, although they are stockholders' equity accounts, dividends and expenses are, if you notice in the expanded accounting equation, they are subtracted. Where we've got plus signs, these are subtractives. They pull away. So I can learn to apply these rules of accounting when I get ready to do transactions, and it will help me to analyze and pick the right accounts and to debit or credit the right account. Some memory hooks to help you remember if you don't have the rules of accounting right in front of you, which I would never recommend a beginning accounting student to ever try to do a transaction without having the rules of accounting laying right there. You can copy one out of the book, you can draw it up, you can make it pretty. I will say I have one of my face-to-face students was struggling, and she came in last week so excited because she said, I get it, I finally get it. And she was just ecstatic that she had figured out how to apply the rules of accounting. And what she had done was draw it on a whiteboard in her kitchen so that every time she walked through her kitchen or was in her kitchen cooking dinner, anytime she was there, she just really saw it was right in front of her face. And she was doing things such as, okay, I went to the grocery store and I spent $50. If I spent $50 on my groceries and I consider my grocery supplies, would I have more supplies or less supplies? After I go to the store, do I have more groceries or less groceries? And then, well, if my groceries are like a supply, then they are an asset. So if I have more, I have to debit them. Cash, well, cash is clearly an asset. Once I spent the cash, I have less cash, so that's got to be my credit entry. And she just tried to apply it like that to everything she was doing at home and try to make it make sense, and it really did click for her that way. So hopefully something like that could help you. She's the first student I ever have who told me she drew on her whiteboard in her kitchen the rules of accounting so that she could watch it, and I thought that was interesting. Memory hooks. DEAD, D-E-A-D, will help you to remember which accounts increase on the debit side. This stands for debit, increases expenses, assets, and dividends. So if I don't have anything else with me, then I'm going to know that if I can think of DEAD, and if I can remember what DEAD stands for, then I can choose the right accounts to debit. When you see the memory hook of red, this is more a Chapter 3 memory hook. Is how you know which accounts are temporary or nominal accounts, and they close at the end of the period. Close means that they zero out to reset their balance, and their balance is actually zeroed out to retained earnings or transferred to the retained earnings account. That's how we get to our definition of retained earnings, of being our cumulative earnings over the period less any dividends we paid out. So we would zero out our revenue accounts, our expense accounts, and our dividends. If you think about the statement of retained earnings, the net income, revenue, and expenses is added to those beginning retained earnings. Dividends are subtracted at the end to get the ending retained earnings. And so when we actually do these closing journal entries, we are doing the process to move those numbers that are being shown on that statement of retained earnings, actually to move those numbers to the right accounts in our ledger so that we have the right balances to start from for the next period. Okay. Any questions so far? Okay. I have someone who admits that they are totally lost when it comes to applying the rules of accounting. And a few other people are saying similar comments here. I wish that I knew some magic that I could just say one word and you could all perfectly understand and apply the rules of accounting. But bottom line is it takes practice, practice, practice. It takes the thought process of every time I'm trying to do a transaction to talk through it, and that's what I'm going to try to do as I move forward with this this little exercise that I'm going to do here as a review. Okay, so bear with me and hopefully this will begin to make some sense. I've gone ahead and written down a few, and this is, I just created a few short things right out of the top of my head. I've created some journal entries that we're going to analyze. I've gone ahead and done some T accounts. I have them linked here, but let me take out a few of these. It won't take me that long to put them back in, and maybe seeing the process in total will help you to understand better. I thought that maybe I could just jump through it, but that's probably not a good idea. Okay, so let's start by looking at and trying to analyze each transaction, and I hope I have my spreadsheet set so we can always see the rules of accounting. If I started a service business by investing $10,000 in cash in exchange for stock, what accounts do you think I would be using? And that's the thought process. What accounts would be affected? That's how we would analyze this transaction. Cash, yes, it's going to affect cash. I see cash coming in. So would I be getting more or less cash? If I am investing $10,000 cash in the business, and these are the business books, would the business have $10,000 more cash or $10,000 less cash? That's right, they would have $10,000 more cash. If I'm getting more cash by looking at the rules of accounting, we have to determine then, is cash an asset, a liability, or a stockholder's equity account? I'm hoping we all know that cash is an asset. So if I have more cash, simply by the rules of accounting, I look and see which side does cash increase on, and it's the debit side. That has to be my debit entry. Okay, and then I need to know which account I'm going to credit. So if I issued it for stock, and I try to make these definitive enough that you could figure it out, I hope that you would know that my choice is common stock. The company would have more outstanding common stock, and that's what this account represents, is how much stock is outstanding, and it would be more outstanding, so an increase for common stock of $10,000. Okay. My second entry, we purchased $500 of supplies on account. Some more terminology here, and we have to decide, first of all, which accounts would we use. Well, hopefully, since we bought supplies, we would know that we're going to use supplies. But what does on account mean? When we see the terminology of on account, that means that it's going to be either accounts receivables or accounts payable. Accounts receivables is an asset account, increases on the credit or debit side, decreases on the credit side. Accounts payable is a liability account. It's something that we owe, while a receivable is something that someone owes us. So in this case, if I purchase supplies and my supplies are an asset, I would have more supplies. That has to be my debit because assets increase on the debit side. And then the question is, would this be an account receivable or an account payable? Type in your answers. Okay, I see a couple payable. There's a couple receivables. So we have a little bit of confusion. Think about this. Is this something that someone's going to owe the business or something the business is going to owe? That's right. It's something the business is going to owe. I see some answers popping in as that. And if this is something the business is going to owe, that makes it a liability, something we owe. And do we owe more or less? We owe more. So we have to increase that on the credit side. We purchased a computer with an estimated 3-year life for $600 cash. Again, we purchased a computer. A computer would be an asset. We have more computers than we did before we purchased it, so that's an increase. And I said for cash. So if we bought this for cash, that means I now have less of an asset or less cash. I want to show you too that in my journal entries here, you'll notice that I'm putting my debit entry first. My credit entry I'm increasing or indenting. So I have my debit is on the left. I'm indenting my credit entry to be indented over to be on the right. In each column, my debit is this is my debit column. The left-hand column is. The right-hand column is my credit. Those are just a little bit of information about how a journal entry should be entered. To be in good form, it must be entered this way. You also notice that my debits and credits are equaling in every transaction. They must equal in every transaction. If a customer paid in advance for $700 worth of services, then if somebody paid, what do they use? When you see the terminology paid, then cash is usually involved, right? So if someone paid the company, then cash would have been received. Again, cash is an asset, increases on the debit side. And this paid in advance. If a customer pays me in advance for services I have not yet performed, that is a liability. I owe that customer that work or that service to make up for that cash they've already paid me. That's typically called an unearned revenue account. Okay. And liabilities increase on the credit side. We provided services to customers on account. Again, here's this on account, but when I'm dealing with customers, accounts receivable would be what's connected with that, because if I do work for my customers or sell something for my customers, then they owe me money, so that's a receivable. Receivables are assets. Assets increase on the debit side. And this would be what I'm in business of doing, my service revenue. Revenue increases on the credit side. So this is how, even though for many of you I'm sure it still doesn't make a lot of sense all the time, and then the problem becomes, which account do I choose? As soon as I know which account to use, which is made easier by my accounting lab because you've got a list of accounts to choose from. So then you just need to determine which of those accounts, and then once you know which account, you have to decide if that account is an asset, a liability, or a stockholders' equity account. And as soon as you have identified or classified that account, you can look at the rules of accounting and know whether you need to debit or credit it. I paid cash dividends. So if I paid cash, I'm going to have less cash. And I have paid out dividends, so I have more dividends paid out to increase that dividend account. So my dividends would need to be my debit. We're on the left side, and I've paid out cash. I have less cash here. Okay. And then my last regular entry that I have here to look at today are I collected $2,000 from customers on account. So if I collected cash, I got cash. Cash increases on the debit side. And here's our tricky on account word again, but customers is tied with it. So if customers, it would be accounts receivable. So if customers paid me $2,000 what they owed me, they now owe me less. So that needs to be a credit. The next thing I need to do is to post or transfer these amounts to my general ledger. And remember, I'm using T accounts to represent my general ledger. The left side of each of these T accounts is the debit side. The right side is the credit side. I need to just simply transfer my balance. So if I have a debit, I move it to the debit side. If I have a credit, I move it to the credit side. And that's all I'm doing here. I'm doing what's called linking or relative addresses. I'm hitting the equal sign and moving the amount where I need it. Anytime I can do that when I'm using Excel, it cuts down on data entry errors because we're all human, and the more times human fingers touch things, the more apt we are to make a mistake. So as you can see, I'm just transferring my balances. If it's a debit, I'm moving it to the debit side. And if it's a credit, I'm moving it to the credit side. And I'm going line by line. I'm not jumping around, because if I jump around, then I might miss something. I would typically be doing post references if I'm really using a journal and a ledger in the real world. I'm going to do what's called post reference, and I'm going to say, as I move this number, this $300 cash, for example, I would have to say that came from my general journal page 1 or my general journal page 2, whichever page in my journal that came from. And then I would come back over to my journal and I would say I put that into my cash account, and my accounts are going to be numbered. So any asset is going to start with a 1. So 1111 might be my cash account. And so I would put that post reference back over. That's just a little added information that you need to know for a real world manual system. It doesn't work so much that way in a computerized system, but it's still, you need to know how it gets from one account to another. So my unearned revenue. If you have any questions about this process as I'm going, go ahead and type them in, and as soon as I finish posting, I'll check all those questions. Okay, I've got all of my balances transferred, so I don't see any new questions here. At this point, I would need to balance my columns. I actually already had some little footing balances in over here for the two accounts that had more than one entry. And the reason that I'm putting it off to the side as a footing balance is because as I finish my adjusting entries, I will need new balances, and I didn't want to put a balance in and then by linking my spreadsheets, then changing my numbers. If I was doing a complete manual process, I could put my balance in and then just go from that balance. Once I have this done, my next step is to prepare a trial balance. All a trial balance is a listing of the accounts out of the general ledger that have balances in them, and I'm just pulling those balances in to make sure my debits equal my credits. As long as my debits equal my credits, it doesn't mean that I haven't made a mistake, because I could have done an entry what I would say is backwards, where I credited what I should have debited, or I could have used the wrong account but for the right amount. And so it doesn't mean I didn't make an error, but at least my debits equal my credits. So I had gone ahead and typed out my accounts here that have balances in them. I'm just going to quickly link to my balances. To try to not make mistakes that way. And I have my T accounts in account balance order of how they should be listed on a financial statement and how they would be listed in a ledger. My assets first, my liabilities second, my stockholders' equity, my revenue, and then my expense accounts. So we're talking about lots of different concepts as we go through this. And that's okay, because that's how you help to tie it all together as we move forward. So if it's got a credit balance in its little ledger account or T account, I have to put it in on the credit side. Now the trick is to make sure that your debits equal your credits. I will just do a little summation here to do that. Drag that balance over. And my debits equal my credits. I'm going to stick in a little formatting to make it more readable. Okay. The double underline means the end. Okay. So that's my first trial balance. Then I'm going to look at my adjusting entries. I'm going to come over here and I have a few adjusting entries. Why do I have to do adjusting entries? It's important to understand the concept of adjusting entries, the type of accounts that are used for adjusting entries. And there's two types. Can anyone tell me the two types of adjusting entries? Okay, typing in, I see some people are saying deferral and accrual. Some people are saying one or the other, and those are the two types of adjusting entries. We have deferrals and we have accruals. A deferral is when we have postponed, recognized something as either an expense or a revenue. So, for example, when we would have prepaid rent, we paid our rent for 6 months in advance, or prepaid insurance, or we pay our insurance for 6 months, but then we expense off 1 month at a time. Those would be an asset that we have listed as a deferred. It's a deferral. We are postponing recognizing an expense until that expense has actually been incurred. As we look at our unearned liability accounts, that's an example of a liability that we are postponing. We are postponing earning the revenue, or recording the revenue, not earning it. As soon as we earn it, we record it, because that's the revenue recognition principle. We record revenues when earned and expenses when incurred. So that's what these adjusting entries also help do. They help us to match up the expenses with the revenue that they help to earn. And that's the matching principle. It is required under GAAP, or generally accepted accounting principles. So let's look at Oh, that was deferrals. Let's talk a little bit about accruals. Accruals are things that have happened during the month, but we haven't made any entry related to those yet. For example, maybe our employees have earned some payroll that hasn't been paid. So because that expense is not yet on the books, we need to get that on the books to match against the revenue that we have recorded. Or maybe we've made some sales and we just haven't invoiced the customers yet, so we need to go back and make sure we have all those customers invoiced to get those sales on the books. Other things that would be common accruals would be if we have a receivable, like a note receivable out there, we would be earning interest on that, and interest is accruing. If we had a note payable where we owed someone that was an interest-bearing note, we would have interest expense accruing out there. Income tax expense is always accruing, even though we typically just pay it once a year or quarterly, it is accruing. So that's another example of an account that would be an accrual. So here we have $400 of supplies have been used up. Well, in this case, I told you how much had been used. If I had said we had $100 worth of supplies left, we would have used the same $400. But we now have less supplies, which is an asset account. So that has to be my credit entry. And I'm just going to start with my credit so that you can see if I know one side of my entry, I can do that. And then the way I can figure out the other, I know it has to be 400. I know that. So what account could it be? Well, I need an account that debits. So if I've used it up, would it be another asset account? Nope. If I used it up, would it be a dividend? Nope. The only thing that's a dividend is a dividend. And that means we've got to have an expense. Well, look, conveniently, expenses increase on the debit side, and this would be increasing our expense. So I would have an account called supplies expense. And supplies. $300 of the amount paid in advance has been earned. That was, if you recall, my cash and my unearned revenue. So now I have earned that, which means I will have less unearned revenue. If you recall, unearned revenue was a liability account. So if I have less, I have to debit it. So I'm going to debit unearned revenues. And it has now been earned. So what is my account that I have on my books as earned revenue? It's the service revenue account. And revenue increases on the credit side. Depreciation expense on the computer is $200. Expenses increase on the debit side. And what other account do we use when we are doing an adjusting entry for depreciation? Can anybody remember? It is a contra asset account. Does anybody remember what that's called? Yep, you got it. Accumulated depreciation. Okay. And then we have $600 worth of salaries have been accrued. So when I was just talking about accruals, I was saying that if we had to match our expenses with our revenue. So if my employees have earned salaries, which I'm not going to pay them till the following period because of when the month ends, or I withhold their pay for a week or 2 weeks, that is going to still be recorded as a salaries expense. And it will become a liability of salaries payable. When I do pay them, then I will just take it out of the salaries payable account. I won't hit the expense account again or record more expense into that account for that $600. So that's just a few adjusting entries. We would then need to post our adjusting entries. I need to add in some expense accounts. I think I have supplies expense. And supplies. So again, to post or to just transfer my numbers to my ledger accounts. Unearned revenue. Depreciation expense. Accumulated depreciation. One thing, remember I said when I asked you which accounts, and I said it was a contra asset account for accumulated depreciation. A contra account is always related to another account. In this case, our accumulated depreciation account would be related to our computer account. And what it does is it has the opposite balance of the account that it's related to. So since our computer is an asset with a $600 balance, accumulated depreciation is a contra asset. That means it increases on the credit side. What these two is net against each other to get my carrying value for this fixed asset. So my book value or carrying value for this asset at this point in time would be $400. Just a little side note there. Not something that we have talked about. So, I mean, we have talked about it, but not a lot, and we'll have a whole chapter on depreciation coming up. And then I had salaries expense. And salaries payable. Hopefully I didn't miss anything. I'm going to do a balance here. And my balance is on whichever side of the T account or the ledger account that has the bigger number, but an asset should always have a debit balance. Okay. Okay. Then I just need to recreate a trial balance again. I'm going to take these amounts or these account numbers. I now have additional accounts that had balances. I have a salaries payable and accumulated depreciation. The joys of Excel is that you can make these changes pretty quickly. Okay, so I'm just inserting my other accounts to have them in account order. Okay. Same thing, I need to transfer my balances over. If it's a debit, it's a debit. If it's a credit, it's a credit. Did you see me just get carried away and throw that revenue in the debit column? I know better than that. And my trial balance wouldn't have come out. Maybe I should have left it there so I could have said, where did I make a mistake? Okay, again, I would need to sum my columns to make sure they equal. And they don't. So that means I forgot to do something. So my difference is $300. If I'm off by $300, then the first place I would look at would be my $300. Unearned revenue, 300. And that's what I did. I didn't balance my unearned revenue account. So that guided me right toward where my error might be. See, I don't even have to try to make a mistake to make you understand how to find them. I can accidentally make a mistake. But that's how fast you can solve it when you understand how everything ties together. So I had the difference of 300. I looked for a mistake that was 300 or an item that was $300. If that didn't, if it wasn't that, I would have divided that $300 by 2 to see if I had a $150 entry somewhere that I forgot to put in. And as long as I just make one entry, that'll catch almost all of our errors when we're doing trial balances. If we do something like a transposition or a slide, we mix up the order of our numbers or we add extra zeros or move the decimal point. The difference between those two accounts, if that's the only mistake that we have, the difference will always be divisible evenly by the number 9. So if you have a difference and you can't find it by just the item number or dividing by 2, and you divide that number by 9, then that's a little harder to find sometimes if you've done a transposition and you sometimes have to go back and go line by line and look for that posting error. Okay, few minutes here, I want to go ahead and do the income statement and statement of retained earnings and the trial balance. So an income statement is, the date is for the period. So if we were doing a monthly financial statement, we would say for the month ended, or if we were doing an annual, for the year ended, and put the last date of the year there. And it includes revenues and expenses. So we are going to pull in any revenue accounts, and I can just do that by I can do it many ways, but I'm just going to look at my last trial balance here. That's what I prepared it for. I'm going to pull my numbers right off of here. So I can even just do it this easily by having this spreadsheet here. I can do a copy and paste my numbers up here. So I've got my revenues and expenses all moved up here now. I just have to link them. So I have equal and equal Excel is just so great to get my total expenses. If I can find my underline. My net income is $3,100. Okay. Statement of retained earnings is my beginning retained earnings plus my net income minus dividends. Okay. It doesn't like that. I wouldn't say the plus and minus. I would just show my numbers, but I want to put that in here so you guys understand. And I get my ending retained earnings. Because I was a new business, my beginning retained earnings was $0. If I was a business who had been in business for and closed a period before, then I would have already moved my amounts from revenue, expenses, and dividends to my retained earnings, and then that is the balance I would go from. And I would get that balance out of my chart of accounts, or not my chart accounts, out of my ledger account. My net income, I will just pull from the income statement above. That's why you have to prepare the income statement first. My dividends, I will go get those from my trial balance. Okay. And my ending will be plus my beginning plus my net income minus my dividends. Okay. And then I need to do my balance sheet. A balance sheet, I will list my assets, most liquid first, then my liabilities and my stockholders' equity. Don't forget we need to add in our retained earnings. Makes my total assets 14,500. My liabilities need to equal that. Okay, if I get all my columns in right, that'll help. And my retained earnings, I pull from my retained earnings above, my retained earnings statement. And my dividends have already been put into that. Okay. So the plan is for my total liabilities and stockholders' equity to equal my total assets. That's how I know my balance sheet is in balance, and it does. So I've just completed my financial statements, and I was trying to have 15 minutes to look at the next chapter, so we're almost there. The other things that we would need to do would be our closing entries. What are closing entries? Closing entries are where we zero out our temporary accounts. If you recall, our temporary accounts were our revenues, expenses, and dividends. These are zeroed out to the retained earnings. We are moving them, basically, we are making the adjustments in our ledger or zeroing out the things in our ledger. And the only way to do that is through doing a journal entry. Nothing happens in accounting if you don't do a journal entry. So any of these changes have to start with a journal entry. So we now need to zero out any of these accounts that are on our income statement and our dividends account. How do we do that? It's the same process every time. We will close our revenue, our service revenue, to retained earnings. I want you to think about something here. Revenue has a normal credit balance. If I want to make the balance zero, I have to debit it. Revenues would increase my retained earnings, so I would have to debit my retained earnings. So to come up here and look at my actual numbers, I have in my service revenue account, I currently have the balance of $4,300, so I need to debit for $4,300. And I just credit my retained earnings for that amount. If I post that, I will transfer my amount to the credit side here. And to my retained earnings account. I've just zeroed out my revenue account. If I put my balance actually in now, it's plus this, plus my 4,000, plus my 300, minus my 4,300 debit that I just did. My balance is zero. Accomplished my goal of zeroing that out. I need to close my expense accounts. Again, my expenses increase on the debit side, so if I want to zero those out, I will have to credit them. Also, an expense reduces. See this little minus sign here in the expanded rules of accounting? It reduces my retained earnings. So if I have my retained earnings, would be my debit, and I will have all of my expense accounts, which are, I'm going to just do it as quickly as I can by pulling them back out of my income statement over here. Make sure I have them indented. Okay, and I can just check my balances in my ledger, and in my ledger they are 400, 600, and 200 respectively. And I can just total those up. Okay. And to post those then, my retained earnings would get a debit, a reduction to my retained earnings. And I will credit each of my expense accounts for hopefully the appropriate number. Then when I did these backwards somehow. Okay. And then when we go to balance our accounts, 400 minus 400 is 0. 600 minus 600 is 0. And 200 minus 200 is 0. We've zeroed out our expense accounts. Now the only thing left we have to zero out is our dividends. Again, it has a debit balance. We need to credit it to make it 0. And it also has this little minus sign in front of it in our expanded rules of accounting. It's a reduction to retained earnings. So that would be a debit to retained earnings. I think I pulled the wrong 100. Let me get the right one. And that makes my balance in retained earnings $3,000. My balance in dividends is 0. And I've accomplished my goal of zeroing out my red account or temporary accounts. And I have updated my retained earnings to 3,000. It's now 3,000, which is when I did over here my statement of retained earnings. My balance was 3,000. So I've zeroed out those accounts. I'm ready to start my next month. At this point, I would probably always run another trial balance, and it would just have my real or permanent accounts on it, being my assets, liabilities, and stockholders' equity. If I ran a report out of my computerized accounting system and it told me that I had an expense still on my post-closing trial balance or after I had done my closing entries, then I would know that I had made a mistake, hadn't gotten everything closed, and I would go back and fix that. Okay, that's the accounting process in a nutshell. I threw a lot of terminology at you. Any major questions? I did not specifically cover a bank reconciliation here today. You can go out and look at one of your past homework bank reconciliations, and you should be good to go for the exam. Any major questions about the exam now? Yeah, I see that some of you are a little worried and a little fearful. Just put your time in before you study or before studying before you take the exam, and don't wait until late Sunday evening to start it. You're going to be much better if you start your exam on Saturday before everyone is out there at the last minute crunch on the computer trying to get their homework done, and you're going to feel less stress. Good luck on your exam. Now I'm going to take a really quick look at Chapter 5. Chapter 5 is going to talk about short-term investments and receivables. I'm not going to go a lot into the terminology for investments at this time. You need to read about the terminology. The things that you will need to pay close attention to as you get ready to complete this are there are 3 types, and those are trading securities, available for sale securities, or held to maturity securities, and there's a few differences in those. Some items we report at fair market value, and in order to do that we used accounts called unrealized gains and unrealized losses. A gain reacts to the rules of accounting like a revenue. So a gain increases on the credit side. A loss is more like an expense, so it increases on the debit side. If you try to put some thought process to that, a loss would make you have less net income, while a gain would make you have more net income or more profit in your business. So I wanted to just point that out briefly, and you still do journal entries to record these. You have the realized gain then, or the real gain is when you actually sell the item. So often you hear the terminology of a paper loss. You know, I have a paper loss. That means that I have an unrealized loss, or a paper gain. That means I have an unrealized gain, but I don't have a real loss or a real gain or a realized one until I actually sell the investment. So there's quite a few little charts and reading and examples of the entries that you would use with these securities, but there's not anything tricky about that, I would say. And I want to spend a little bit of time on the items that are a little more confusing. We need to always remember to apply GAAP, generally accepted accounting principles, for proper revenue recognition. Revenue recognition is actually when the performance of the obligation is satisfied, the goods have been transferred to the customer, the price is fixed, and the collection is reasonably assured. So shipping terms affect this. Have any of you ever seen shipping terms on an invoice? Have you dealt with a company that it says the shipping terms? Okay. And we're just going to look at a slight example here of where iPhones are being delivered, and so we have an account receivable for $3 million and sales revenue of $3 million. But then, one thing that matters when we're getting ready to decide when to do that journal entry is, what are the shipping terms? How do we decide who owns that and when the point of sale takes place? If it's shipping point, then the inventory becomes the buyer's or belongs to the buyer. The sale is complete as soon as it leaves the shipping dock of the seller. That also means that if there were damage to the inventory in the hauling, an accident on the interstate or something, that is the buyer's inventory, and it's their cost. If it's FOB destination, it does not belong to the buyer, or the sale is not complete until it arrives to the buyer's dock and is unloaded, and then it belongs to the buyer. So at that point would be when the sale was complete and the revenue was earned. Okay. Another thing that we all see on invoices are discount terms. For example, and the slide may not be keeping up with the recording, but if we see something that says 2/10, comma, N/30 on an invoice, does anybody know what that means? Yep, the N/30 does mean that the total amount of the invoice is due in 30 days. How about the 2/10? Nobody? Well, the 2 stands for a 2% discount, and the 10 would be if paid within 10 days. It's very advantageous to a business to take advantage of this incentive to pay early. It saves the company who is buying a tremendous amount of money. It's even very, very profitable if they have to borrow money for 20 days to be able to pay it. And the thought process behind that is that if I'm going to have the money in 30 days anyway, then if I have to borrow it at the end of the 10 days, I only need to keep it for 20 days because I'm going to have it in 20 more days anyway. So if I borrow interest at even a relatively high percentage rate, I'm still going to come out ahead to do that. So I should keep a line of credit or something for my business in order to take advantage of all discounts. So an example of this entry for like the $3 million purchase we had just seen earlier is that we would get a sales discount of $60,000. That's truly worth taking note of. Okay, if I have damaged merchandise or it's unsatisfactory, I have a right to return that. That would be an account called sales returns and allowances, and that would take that off of what I owed the company and reduce my accounts receivables. Now, I want to point out that sales returns and allowances and sales discounts are contra sales accounts or contra revenue accounts. That would mean they increase on the debit side because they offset the sales account. We would have sales minus our sales returns and allowances minus our sales discounts, and that would give us our net income. So you start with gross, take off any of your accounts that would reduce your total sales, and then you have your net. Another little topic that we might want to mention here is that up to this point we've been talking about accounts receivables and accounts payable basically as just like they're just accounts. We're not talking about who all owes us the money, and we obviously would have to keep track of how much each different customer owed us or how much we owed each individual vendor. So receivables are considered the third most liquid asset. They are monetary claims against others. We get accounts receivables by selling goods to our customers. And if we lend money, it's called a note receivable. Basic entries to record would be an increase in accounts receivable on the debit side as an asset and an increase in our service revenue on the credit side because it's a revenue account. And if we were lending money, we would have an increase to our note receivable, which is an asset, and a decrease to our cash, which is also an asset. We have to keep, as I said, a subsidiary ledger or track of individual customers. That means that we have, in our general ledger, we have an account called our accounts receivable account that has the total of what all of our customer owes us. And then we have a subsidiary ledger off to where when I record a payment, I would say I received $1,000 from FedEx. And then in that case, then FedEx owes me $1,000 less. So I would have to record that in both my accounts receivables control and the FedEx subsidiary ledger account. A note receivable is a written promise to pay. Basically, it's a contract, so it's a little more secure than an account receivable. So if I have a customer that gets behind on their payments, I may want them to sign a note for me, and then I start charging them interest. We talked a lot about controls over cash, and you would need to have controls over receivables as well. Make sure that you read that section in your textbook, but you should be good to go with that. I briefly want to talk about the two different methods for accounting for allowance for uncollectible accounts. This all falls back to GAAP and to the matching principle. We want to make sure that we match our expenses with the revenue that it helps to earn. And unfortunately, if we sell items to customers, we don't always collect 100% of that, so we need to estimate how much of that money is not going to be collectible so that we can match that expense against that revenue in that period rather than wait 6 months down the road and we say, oh, that customer is not going to pay us, and so I need to write that off of my books today. Well, then I've just overstated my income in January, say, and understated my income in July because I didn't write that expense off back when I made the sale. But the thing is, I don't know who's going to pay me and who's going to not, so I have to just do it as a percentage, and that's where the allowance comes in. A percentage or do an aging of my receivables. And there's two methods, the percentage of credit sales and the receivables method, which is an aging of those receivables. So with the percentage of sales method, it's called the income statement approach. You take the estimated amount of uncollectible percent, which is an experienced number. It's something that we've built up over time. We know how much we usually don't collect, or if we're new, we get our CPA, or we look at the industry standards for this and use that to start with, and we can always adjust because this is truly just an estimate. And we take it times our sales revenue, and whatever number we calculate, that's the number that we use in our adjusting entry. So here's an example. If it was 1/20% of their sales are uncollectible, or their total revenues, and we have to assume that these are total credit revenues, because if it's part of that is cash, we already have the cash, and cash is, then we've already collected it, so it doesn't need to be figured into the percent of uncollectibles, just our credit sales do. So we go through this little calculation to get the amount of $78 million, and that is the amount that we actually use. The account is uncollectible accounts expense and allowance for uncollectible accounts. It also can be called bad debt expense, allowance for doubtful accounts. So there's several names you might run across out in the real world, but as soon as you identify that it's their allowance account, then you ought to know how to treat it. Okay. The aging of receivables is known as the balance sheet approach. It's how much is uncollectible. And the difference with this is we always adjust our balance in the allowance for uncollectible accounts to the number we calculate. So if we are using an aging of receivables, we actually list all of our invoices. If they're 1 to 30 days old based on date, 31 to 60 days old based on date, 61 to 90, or if they're over 90 days, we might take it all the way out to 120 days. It depends on what our policy says on how often or how old a debt has to be before we write it off as an uncollectible. It's one of the things that can get companies in trouble, and this is what got WorldCom in trouble when several years ago, was that they knew they had bad debts on the books, but they didn't write them off, and that made their accounts receivables look higher than it really was, and they got caught for that. Their policy said they would write bad debt off, and they weren't writing it off. So that's a way to make your assets look higher, but it is not okay to do. So in this case, on the slides, on the PowerPoint slides, and if the slides aren't keeping up with this recording, you can open the PowerPoint slides and click through, and you will see on slide 555, there's actually an aging of receivable example, and they show you that it comes up to 98 million. When we look at this 98 million number moving forward to do the adjusting entry, we already had $10,000 as our beginning balance and in our allowance for doubtful accounts, so our adjusting entry is actually 88,000 because we want to make our balance when we're using the aging of receivables. We want to make our balance be in the allowance account whatever that aging told us it should be. So sometimes we have to debit, sometimes we have to credit. Then when we need to do a write-off, we write it off from the allowance account because now we know who's not going to pay us. We already expensed it, and we just write it off from the allowance for doubtful accounts and take it out of accounts receivable. And that's pretty much the time we have tonight. Of course, you can always, always, always ask your instructor for clarification. I think that's one of the things that I'm seeing pop up in some of the questions of, I'm lost and I don't know where to go for help, and is there, we can't find help. I encourage you to reach out to your instructors first. I encourage you to find your, to get to know the people at the region that you are registered through, your home campus per se. And at your home campus, there should be someone there, a program chair or someone that can assist you and help you if there's tutoring not available. I know a lot of the small regions do not have official tutoring. At our region, myself and my full-time